नमस्ते इन्वेस्टर्स. दिस इज ध्रुव बजाज फ्रॉम स्मार्ट सिंक सर्विसेज. हमने रिसेंटली मिस्टर विवेक मशरानी जी को हमारे प्लेटफॉर्म में बुलाया था. फॉर दोज ऑफ यू हु डोंट नो हु विवेक मशरानी इज, he is an experienced investor having experience of more than 2 decades, and he is also an author of a best-selling novel called You Can Compound. So through this session he explained us his ideology and investing process, that is Technofunda investing. So do watch this session and let us know your views. Thank you.
A very good evening to all of you. I am Ankit Kanodia from Smart Sync Investment Advisory Services, a SEBI registered investment firm. Welcome to the 14th episode of Mission Smile guest webinar. For people who are joining for the first time, Mission Smile stands for Making New Stock Market Investors Learn It Through Engaging Research. And in the guest webinar edition of Mission Smile, what we do, we request our peers from the industries, friends from our industry every month and learn from them their investing style through their presentation, through case studies. So today I'm very happy to present in front of you all Mr. Vivek Mashrani. Apart from a very good investor, a Technofunda investor, many people know him as a Technofunda investor. He has actually brought a revolution in, at least in Indian stock market, by introducing Technofunda investing. And he has a lot of fan following, not only on social media, but also in his own community. And he is doing a great job of educating people about investing. Apart from that, he's a very dear friend and has been a very good source of motivation and help whenever I need. So I'm very, very, very excited, and I'll keep myself shut and let Vivek bhai do the talking. So over to you, Vivek bhai. You can share your presentation.
Thank you so much, Ankit bhai, for the kind introduction. And yes, this topic and area has been very near to my heart, and love to share whenever. So whenever you told me that let's do this, I thought, yeah, let's spread the message and let's help investors in this direction. So what I'll do is first I'll share broadly in terms of what is the process which we follow, like what is a 36,000 feet view in terms of finding the stocks in the core portfolio, and then we'll go about various aspects why we do what we do, and then we'll try to lay over the technical side of it. So 3 parts we'll try to cover. First the overview, then we'll go deeper in terms of the logic and the strategy which we follow, and finally we will blend and layer of technicals, because I'm sure a lot of you might have one side of the exposure, either technicals or fundamentals, but rarely I've seen people having both the sides. Nowadays, of course, the awareness is increasing. But yes, let's first check with all of you, like those who are here live, type in the comment box which is the area which you are more deeper into, whether it is technicals or fundamentals. What is your core strength area? Yeah, so fundamentals, Ashish is saying fundamentals, awesome. Amar Bhandari is saying fundamentals, great. What else? Yeah, JD Tress is saying both. Lata Mahesh is saying funda. Okay, good. So I think majority of you have fundamental side of orientation, and that generally comes when we think about an investor mindset, right? So whenever we see a slightly longer term investor, and today's time and age, like more than 1 year also, if you are keeping, you are a long-term investor, because 90% of people sell before it. So basically, if you are having that kind of horizon, generally, we come from a fundamental construct and we try to think about a company at a deeper level, where it is going. And that is very important in a sense that if you are just blindly following technicals or blindly following price, or blindly following even not that, just the tips which is floating around all over the places in social media, then will tend to buy and sell very frequently, because there is no conviction. So to build that conviction and to have a framework around it, I have developed a formula called machine formula. So some of you who are part of my community might be aware about it, but this will be more like a revision. And of course, if you have any gaps, you can ask questions. For those who are not listened to me earlier, this will be like a fresh perspective. which you will be able to connect and take home. So are you all ready for understanding the framework of machine? Just type yes in the comment box if you are all ready for this. And this is my style. I like people to comment so that I know that you are on track and I'm not just speaking with myself, because I have shared this topic hundreds number of times. So, for me, it is like even at middle of the night, I can speak about it because this is what I do every single day, every single time. So machine basically is a kind of framework. If you have heard William O'Neill, he has written a very wonderful book called Making Money in Stock Markets. And he has a formula called CanSlim. So I thought, why all the foreigners should have all the fun, we should also have some methodology through which we are, identifying the stocks. So this is what, broadly machine formula stands for. Now, if we try to think around it, the first very important component is mega trends. Okay, like what is the big trend that is going on? Let me ask each one of you, like, what is the no-brainer trend that you see around you? You don't need a investing knowledge for that, but it is visible to all of you. What are some of those big trends that is in front of you? I'm not even talking about sectors as of now. Just think about what is happening around you, like which is irreversible most likely, and which is like bound to happen almost 99.99% of time. Yeah, so somebody is saying discretionary consumption is going up. Yes. Then infra development. Yes, more and more infra is getting generated. What else? Think out of the box, not sectors, not companies. We are still 36,000 feet. Okay. Consumption patterns are changing. Yes. What is structurally happening in our society? Because that is where the businesses will come into the picture. What is happening? So one, infrastructure development is happening. Do you all agree that urbanization is a very, very big trend? Financialization is a very, very big trend. Increasing consumption due to rise in per capita income is a very big trend. Digitalization is a very, very big trend that is going on. Yeah. Getting it? All of you are getting it? So this is how you need to think about it. That, okay, what are the trends that is going on? What is happening in the financialization side? What is happening in the digitalization? What is happening in the infra space? And then slowly we need to go downwards and start thinking about now who will get benefited from it. Yeah, even premiumization is a very, very big trend. So that is where, these are some of the mega trends that is happening. Now, to give you a context, and by the way, whatever we discuss in this session will be all examples, case studies. None of these, what we discuss, will be any kind of advice. And we are SEBI registered RAs, so we might be holding some of these stocks. So standard disclaimer. So please do your due diligence. It is more to share the process with all of you. There is nothing. The stock ideas will automatically come to you if you understand the process. That is how I think about it. So if you think about the diagnostic sector, for example, a lot of these structural trends which we talked about, like unorganized to organized, digitalization, urbanization, nuclear families, pollution, lifestyle changes, everything connects and helps this sector. So this is how you need to think about it. Like, if say connectivity is improving, if say infra is improving, more and more people are taking flights, can you tell me which sector will benefit? Now you go slightly deeper downwards. Which sector will benefit if that is happening? Luggage industry. Yeah. So this is how you should think about it. That, okay, if one sector or mega trend is really doing nicely, there could be implication in a multiple way. There could be a chain effect where other sectors are also impacted. Okay. So this is how you boil down further in terms of sectors ultimately. Clear? So this is the example of how to think 360-degree in terms of broader structural trends. Now, if you think about the building blocks, what are the building blocks? If you want to think about returns, these are the two parameters through which equity returns get generated, right? So you have change in earnings, and then you have change in price to earnings multiple. So say for example, when you bought a company, you bought at earnings of 20 rupees and you paid 5 times price to multiple to it. So your price was 100 rupees. Now that 100 rupees price became, say, 1000 rupees, and the earnings from 20 rupees, it became 5x. So your earnings from 20 rupees became 100 rupees. Now, what is the multiple somebody is paying you when you are exiting, say at 1000 rupees? They are paying you 10 times multiple. So what has happened in the process is your earnings has become 5 times and your P ratio has doubled from 5 to 10. And that is the reason you are getting the 10x returns. Are all of you with me so far? How this calculation is working? And you take any stock for that matter, this is the same calculation, it will work everywhere. If all of you are clear on this, just type clear in the comment box. Awesome. Thank you so much. So this is the first part. Okay. Now, if you think about it, how these things get generated, these things generate based on two things. One is the underlying fundamentals, right? So all the earnings growth will happen due to the business performance, and the PE re-rating will happen because of market sentiments, how people think about the company. Now, why do we get companies in bear market at a cheap valuation? Can anyone tell us why the same company you get extremely cheap when there is a bear market, or when there is a fear situation, or when there is say COVID kind of situation? Why does that company trade cheap? Absolutely, Ashish, bang on. So sentiment is down, there is fear, and valuation gets derated. It's the same company, by the way. 2 days, things change suddenly, right? So earnings will not deflate so much, but then your fear factor or the expectation or the sentiment of the market is affecting it. So in the short run, the weight of the sentiment is very important because it can change the price very frequently. In the long run, as you go more and more in terms of time horizon, your earnings will be very, very important. And that is the reason when we do anything for short term, like anything less than 3 years, we also want to focus more in terms of where the sentiments are going, where the sector tailwinds are going, what people are thinking about it. And when we are thinking about extremely long-term investment horizon, we want to think more in terms of the earnings, where the company can grow. And that is the reason the mega trend, the first part itself, which we discussed, is very important, because that will tell you that if a structural trend is in place and a company is benefiting it, then this can last for a long period of time. So say, for example, you all told about luggage industry, say Safari, if you see, for very, very years, from almost 2013, since the air travel and connectivity and more travel related infrastructure has improved, the kind of volume growth and the share price appreciation thereby that has happened is tremendous. Okay. So that is about the building blocks in terms of returns. Now, when you want to dissect earnings, there are only 4 things you can dissect in terms of earnings. So you can dissect sales growth, you can dissect operational leverage, you can dissect margin expansion and debt reduction. The earnings growth comes only from these 4 components. You take any company, you pick up any con call transcript, these are the only building blocks through which earnings will grow. And there are 2 parts to it. One is in their existing industry. So say, for example, my entire sector is growing. Say 2018 graphite industry was growing. all the companies in graphite industry will get benefit out of it. Now say there is a stronger company which is able to take market share from other company, then the stronger company in the existing industry can gain. You can also grow by launching a new product. So say, for example, Pepsi is launching Sting and it has got amazing market share and it has grown its profitability. You can go into a different geography and grow. You can open a new category. You are selling a masala vada pav, you sell cheese vada pav. So you can open a new category inside your business. Now, from all these four, which is the most sustainable trigger for growth if you are investing for long term? Type in the comment box. Out of these four, which is the most sustainable growth trigger? Yeah, absolutely. Sales is the most sustainable growth trigger because you cannot increase your operating leverage, as in you have a plant which can produce 100 units. Right now you are producing 60 units. As you keep increasing the utilization, your fixed cost is same, your variable cost will start decreasing. So sorry, variable cost will remain the same basically for each unit, but your fixed cost is same. So your overall, cost is decreasing as you produce more and more. Same way, margin will improve because of efficiency or you are doing some cost cutting, but you cannot do it for infinite time. But sales you can grow for a very, very long period of time. Now, how does sales grow? Sales grow only from two perspectives, price and volume, right? So price multiplied by volume is sales. How much you are charging for a product and how much quantity you are selling. Can you indefinitely increase the price? Most likely not, right? So you can increase over a period slightly and even you need a competitive advantage over there. But then quantity you can increase if the market is big enough. And that is where when you start your process, we think about what is the opportunity size. All of you type OS in the comment box. Opportunity size is super important when you are investing. You take any multi-bagger which has gone 50, 100x. It had a huge opportunity size. Asian Paints, still there are houses and so many crores of village in India where there is no paints which has been done. It is all kacha house, mud house. There are thousands and thousands of such cities where you have that opportunity still. If you see Astral kind of companies, right? Still there are pipings where all the metal fittings are there. If you go to, interior of our country, you will see there is so much of opportunity size over there. If you think about QSR companies, still a lot of people don't eat out. Still the frequency is not that great. We are just getting started. So those kind of small things, if you think about it, it makes a big difference in your investing journey. So this is how the first starting point is. Now the earnings growth is not enough. Can you tell me why it is not enough? Like say a company, you get a company which is growing 50% every year and you are wanting to invest for a long term. Just a couple of years of growth, will that satisfy into your long-term compounding? What else is needed? Type in the comment box. What else you think is very important if you want to compound for a slightly longer period of time? New investments, of course, EBITDA and profit growth, that's already happening. Okay, it's already happening. So what is important is the longevity of business model. If you are not able to even survive after 2-3 years, the entire thing goes for a toss, right? So you need longevity along with profitability. Otherwise, there is no way you can grow for a long period of time. Yeah, so terminal value is very important for any business. Now, to have a terminal value in business, there is a very important thing which you should think about. In a capitalist society, right? If you think about like a purest way in terms of businesses, it's a capitalist society, right? Now think about it. There is a company, there is a firm, and I give example in my community of Rocking Ranjita. Say Rocking Ranjita is selling vada pav near that Gokuldham society, and she's making crazy amount of money because everybody is eating vada pav there, and she's very busy with all the customers. What will happen if somebody is making insane profits? What will happen? Competition will come. Some other guy will come and they will also put up a vada pav stall. You might have seen like some places in your city also, and there is a cow gully, one or two shops are there, then entire line they come up and start competition. They will copy it. They will make exact same looking name, same looking logo, stickers, and probably they might also start selling at a cheaper price, give better service and all that. So competition is very natural, and that is what Peter, who is this guy? Philip Fisher talks about that high profit margins can be compared to an open jar of honey owned by a prospering company. So when honey is open, all the insects will start coming in. That is your profitability or your return on capital employed. When you are making good amount of money, all the hungry insects will start and keep bouncing around it. But there are two ways to protect it, right? One is you have a monopoly, like you have a police wala who says you cannot put a shop here, but that is illegal, you cannot do it. And the other way is you become so competitive in terms of your product pricing and offering that you might be able to generate say 15-20% return, but somebody else produces the same vada pav, they are not even able to match your cost. Okay, so that is how you become more lethal. And that is where it is very important to understand in machine the C, which is competitive advantage, that you need to create a moat around your business through various different competitive advantages, which is probably you can build a strong brand like Nestle, or you have this Cerelac kind of brands, Gillette kind of brands. You can have high switching costs. People find it very difficult if they want to switch your product, say from Mac if you want to go to Windows or vice versa. From Android you want to go to iOS or vice versa. So it's very difficult. You create network effects where each new customer is creating incremental value for all the existing customers. So if your friend comes on Facebook, it is creating more value for all the network of the other friends. Same way, if your friend comes on WhatsApp, it creates more value for each one of you. So WhatsApp is not doing anything incremental, but you get incremental value by each new customer which is getting onboarded over it. So that is called network effects. Then you have low cost advantage, how you can produce at a very, very cheap price and take the cost advantage, and how you can produce more and more and generate economies of scale. You can also create competitive advantage by patents and IP. Now, once you have done this, your focus should be on maintaining higher returns of capital employed. Now, why this is important? Because as an investor, our capital has a cost. Okay, if I tell you that FD is giving 8% return, and you can open a business which is giving you 7% return, will you open that business or put money into FD? What will you do? You'll of course do FD, right? Because you are better off doing FD in terms of risk as well as return. But if you think about businesses like this, you need to think the same way when you are investing into any company. So if you invest in any company which is producing a return on capital employed of say 5%, 6%, you are actually not optimizing your capital. And you will be surprised that there are so many companies out there, almost like 70-80% companies who are on a sustainable basis, not able to even produce 10 to 12% ROCs. But still investor invests there. Because we don't think from the owner's perspective that what if I buy this company, what is the kind of capital generation it is going to do from my money. So that is where the H, which is high ROC, is very important. And why it is very important is because it creates that compounding engine for you if you are investing for a long period of time. So what Charlie Munger says is, like, over a long term, if you hold a stock for a very, very long period of time, it will generate almost the same return, which is the return on capital employed, which it is generating. So if the business is earning 6% on capital or 8% on capital over 40 years, you will make the same kind of returns. And if a business is conversely generating 18% capital return on capital over 20-30 years, you will make a hell lot of money, because that compounding will work in your favor. So when you are investing more and more long term, these factors become more and more critical. If all of you are with me so far, we have reached that H, machine H, so that you can understand what we are going about, right? So there is I, N, and E, which is very easy once you have understood this. So if you have noted this, just type noted in the comment box if you have understood this so far. Okay. So this is what is the context till ROCE. Now, having said all these things, right, there are opportunities, there are transitions, there are things which are dynamic. Okay. So let's take this quadrant. So this quadrant is very, very powerful quadrant. One, we have understood that if we want to compound over a long period of time, we need earnings growth. That is what we understood in the first part. Now, earnings growth is just not enough, because if you grow, but you grow at say 7% ROC, it's pathetic, right? You are actually just burning money, more and more money. It's like you are running an engine by burning money. That is what is the analogy. So that is even pathetic. So if you think about this construct, this matrix gets created. So there are businesses which are, low growth companies and low ROC, and they don't even plow back the capital into the business, because they know that if I put money into my business, I'm generating 5% ROC. I can put into FD, give dividend to shareholders, and they can put into FD and they will be better off. So that is like cactus, which doesn't take more and more water and doesn't grow like a giant tree. But at the same time, if you try to own it and keep it for long term, it's like a cactus. You touch it, more you touch it, the more it will hurt you, the more your hand will bleed. So there is no point in keeping this for a long period of time. Then you have weeds, which will keep plowing back the capital. They will not give dividend to the shareholders, but they will be low ROC business. So they are actually destroying the capital. So this is what is weeds. We should definitely avoid weeds. Okay. The third category of business is mango, which is having a high ROCE, but it's not able to grow further. Can you tell me any example where the ROCs are high, but it is not able to grow faster? Yeah, Bharat is saying Hindi में बता दो, थोड़ा बहुत बोलेंगे, so no problem. I'll try to blend, but flow में थोड़ा सा English ही आ जाता, because all the slides and everything is in English. So yes, Nijo is saying Castrol, Jatin is saying Colgate. So basically companies जिसका past बहुत अच्छा है, the companies whose past is really good, but now probably because of disruption or not having any growth opportunity या फिर competition आ गया, they are not able to plow back capital and go further. So these are the companies which are kind of mango companies. Why these are named as mango? Because they will give you good dividends like Amras every single year, right? Every summer they will give you dividend and you will enjoy the Amras, but then it will not grow further. So these are the kind of businesses which is low growth and high ROC, because they've done something great in terms of product. They are just holding that product but not able to grow further. Okay. And then you have banyan. Okay. So banyan is where you have these branches which keeps growing. So you reinvest your capital and keep growing, keep growing, keep growing. Now the interesting part is only few companies can stay here. Either they will be growing nicely, but then they stop the growth, or the competition comes in, disruption comes in, and they become like cactus. Some companies like cactus, they will try to increase their profitability and become mango. Some high earnings growth companies can also become high ROC by changing their business model, changing their strategy, and also can become banyan company. So there is this transition always going on again and again and again. Okay. And that is where it brings opportunity for investor paisa banane ka. And this is what I do personally. So I keep a core portfolio which is more like a banyan or mango kind of companies. And these are high quality, consistent compounder companies. It could be something like Astral, something like Safari, something like Polycab, those kind of companies where there is good runway, good consistent compounding. And it will not become like 5x in 1 year, but if you hold enough, it will become 10x in 10 years probably, those kind of companies. Now, the starting point of finding these companies is based on fundamentals. But as I said, the world is dynamic. Page Industry was a great company at one point of time. Now it is undergoing a lot of challenges. Kodak was a great company at one point of time. Now it is no more. Nokia was a great company. Now it is no more. There'll be companies which will suddenly start degrowing. The growth will go away. It might be still a good company, still a good brand, still a good product. But as a shareholders, you want to see growth, because only when the earnings growth is there, we saw the first equation, right? Then only you will compound your money. Otherwise, your re-rating will also change into de-rating. So both the engines will work against you. So that is where I use technicals on a longer time frame to take exit decisions, and I'll tell you rationale of it and why it is important, and we'll connect with the numbers also. But just right now, just keep it and park it on your notepad that this is what we do over here. And then there is a satellite portfolio. Now, satellite portfolio is where it gets even more interesting. So these are probably cactus kind of companies or mango kind of companies or weeds kind of companies, which are showing some green shoots, or even cyclical companies where it sometimes look like banyan, but it's not actually banyan. Sometimes it looks like cactus, but it's not actually like cactus. It transition between both. When things go good, it will look extremely good. People will say this is like a structural story, 10 years, yahi chalega. When it goes bad, everybody will say it will go bankrupt and nothing will happen for 5-10 years. And then again, it starts its journey. So that is your satellite portfolio. Now here you cannot start with fundamentals, because when you look back in the rear mirror, everything will look bad. And सबसे पैसा ज़्यादा यहाँ पे बन जाता है. Okay, so that is what happens in the satellite kind of companies. Okay, so satellite companies, you can transition if it is working fine into core ultimately. Okay, are you all with me so far? So when this companies really work in a nice way, you can actually ultimately put it into core. And if it doesn't transition also in that journey, when it transitions, you make a lot of money in that process. Okay, so that is where satellite portfolio comes into the picture. Typically, we keep around 30% in the satellite portfolio and around 70% in the core portfolio. If this is clear so far to all of you, just type clear in the comment box. And looks like there are some dukhi atmas who is wasting time here.
Yeah,
Okay.
I'm working on the same, Vivek bhai.
That is fine. That is fine. I forgot to get some Bernal stock. Okay. Superb. So hope this is clear. If all of you can put a thumbs up if all of you are clear so far in terms of the process. Yeah. So this is how the process goes about. Now we'll straight away jump into some of the examples, like how does this work? Because that is what is very important. Okay. So the fundamental side, you put up the screens, and screening people use a lot of criteria, but I'll just give you the criteria which are super important in the journey, right? So which I prefer to apply. So these are the 6 pillars which I want to generally see in any good core portfolio company. So I want excellent growth. So you can put a criteria of screening and in terms of earnings growth. You can put up criteria in terms of ROCEs, which is return on capital employed, like minimum around 15% ROC and how much they are reinvesting in terms of capital. Another thing which you should think about is longevity, and that is where your competitive advantage. And to put screens, you need to use operating margins. You can use working capital related ratios to understand whether this company is really good. And then you can also put criteria around valuation if you are like very, very obsessed about valuation. I generally put valuation criteria much later because I don't want to miss out a good quality companies just because the valuations are right now not conducive. I want to at least keep them in watch list and study it. And then I want to also see whether the execution is there. That is what is the E of the machine formula. So N is what new they are doing, I is what improvements they are doing, and finally the execution of the earnings. So you can apply screens around these criteria and you might end up into good quality companies. But once you do this entire process, you start using technicals for tracking and entry exit. So I'll just show you how I do it for core portfolio companies. So say for example, this company itself, which I was analyzing today, say Tube Investments is like and how simply you can check whether it is a good quality companies or not. I'll give you a thumb rule. For any company, you open a long-term chart, like 5-10 years chart, okay? And if it is broadly forming a 45-degree like this, most likely it is a consistent compounder company, okay? So this is a very, very simple way to actually try to find reasonably good quality company. Of course, you can then check the earnings and screen it and a lot of different things you can do. But this is like the very basic check which you can do. Another check which you can do is just simply go through its net profit journey for last few years and see if the net profits are generally in an increasing trend. If it is in an increasing trend, most likely it's a good compounding company. If it is a cyclical company, what will happen is it will have a chart like this. Basically, it will have more cycles between it. So let's take a cyclical company like NMDC. If you open its chart, and even we can do bigger time frame, like say this is like a 10-15 years chart. What does it say to you? Whether it is a core company or a satellite company. If you see here, it is a lot of ups and downs. So this is definitely a satellite company. This doesn't fit in our core portfolio companies. So I've seen a lot of investors, they will read 10 years annual report, they will go through con call transcript, 6 महीना बिगाड़ेंगे, and then they will say, अरे यार ये तो खराब company, ये तो long term investment के लिए है ही नहीं. But just see the glance through like this, you know that this is a cyclical company. Now, after that awareness, if you want to really invest and then do your homework, that's perfectly fine. But don't do the reverse thing where you are spending so much of time going through all the reports and everything, and then ultimately you get to know that this is a cyclical company. Many new investors actually make this mistake. So this is where I find technicals also very intuitive, because whatever is going into the earnings, it's actually reflecting on the chart also. It's not that the charts are different from the earnings or profit growth. So either you can look at the profit trajectory or you can look at this. It will be almost on a similar lines. So if you go through the profitability over here, you will see the same trajectory, right? There is a ups and then downs and then again ups and then again down, and that continues. So that waveform is again happening in the charts also. So that is in terms of the satellite portfolio, what you can play. Now coming back to our example. So say for example, you are thinking of investing into Titan, which is kind of core company. Again, this is like an example, but not a recommendation. So say for example, I want to invest in Titan, right? And at any point of time, I'm here. So say you decided that I want to invest over here, or you decided over here, whatever is the time frame. So what I use is generally, if my indicator, and there are multiple indicators which you can use indicators like volatility stop, parabolic SAR. You can use as basic as EMA if you are just getting started. This might look slightly Greek, but just right now follow green and red, this ABC XYZ for now. So say for example, you entered here looking at fundamentals and everything was fine. Then what I do is every month I just track whether it is going from green to red or not. That's it. So only if this turns red, I'll be concerned that there is some problem inside the company. If there is a global event, say the entire market falls and this stock also falls, most likely you can ignore it. Okay, so it is only when the company in isolation falls and this becomes red. That is only point where I exit. Now you might say, but hey, there could be some temporary problem. There could be 2-year problem and then company comes back on track. Very well. You again re-enter when it again starts becoming green. Okay. So the point is, if there is a long consolidation, like say, for example, here, there was like almost like 2 years of consolidation where the price did not move anywhere. And traditionally, that is what we are taught, right? That, okay, if a good company is not performing, we should wait. Now, the question is, how much should we wait? And how much of that good company is priced in, right? It could happen that right now it is looking good. After 1 year, 2 year, there is some disruption coming and other investors are aware about it, but we are not aware about it. Or there is some degrowth that is going to happen in next few quarters, but we are not aware about it. And then how much to wait, right? Whether to wait for 6 months, whether to wait for 1 year, whether to wait for 10 years, or whether to wait for 30 years. No answer, right? And probably if we wait till 30 years, maybe, our next generation will reap the benefit of it, but we will be not making money out of it. So the point is, each of us should have some reasonable horizon for waiting period, because your compounding is getting affected. It's like you are driving a car, suddenly your car stops and it is not working. You want to reach some destination urgently. You still have time. You have still buffer of couple of hours. You wait for 30 minutes. Nobody is there to help you. Nobody is coming. And you keep waiting, and 1 hour passes by. You need to have a time stop loss that, yes, now I'll take a train, or now I'll take a flight, or I'll, take somebody else's help, get their car and I'll go. So same goes with investing, right? So if it is too much of waiting period, the compounding gets affected. So that is where, from whatever strategies I have formed, I generally like to wait for around 2 quarters, but more than 2 quarters, I'll park it, I'll exit, and then again re-enter if it starts performing. But I'll not waste my time there, sticking my capital over there. Worst case, I'll take a tracking position. That is how I go about it. So that is on the core side. Now on the satellite side, it gets very interesting. So whenever there is a change that is happening, something really drastically change, what do you think? Whether the numbers will come first or the news in the insider circle will come first? What will come first? So say, for example, a promoter is putting up a new plant somewhere, okay? And their employees know about it. Some of the circle knows about it. Now, will they wait for the entire numbers to come to buy the stocks, or that news itself will trigger buying? Like today itself, there was a news, right, that CG Power is going to put, the semiconductor plant, and they are seeking the approval. And the stock is up 20%. Okay. So that is how market behaves, right? Market is a leading indicator. It's not a lagging indicator. It doesn't react after the COVID gets complete and all the impact gets assessed and then it falls. It falls first, then COVID goes for next 2 years. That is how it works, right? So it basically tries to digest all the information as soon as possible. It's a leading indicator. And if there is any good news about a company, even in the insider circles, what will happen if somebody wants to take advantage of it? What will happen? People will buy. They will buy the shares. Only then they will be able to take advantage around it. Okay. So that is what happens all the time inside the market. So I'll show you a couple of examples and you'll get amazed that how powerful this can go, right? And it's very intuitive. You will be able to see from naked eyes. So I'll share with you a couple of examples. Let me share this first example. And let me remove this drawings and everything for now. Let me even remove this. So are you able to see the spike in terms of volumes and sudden spike over here? This is what it's called in the technical terms, price volume action. This is nothing but buyer demand. Okay. Now, let me tell you one thing. Please note it down. Whatever fundamentals, whatever company does, whatever is happening, there is only one factor because of which the share price can go up. Tell me, what is that one factor? What is that one factor because of which share price goes up? It's called buyer demand. Okay. If there is no demand, imagine there is a best movie in the town going in a theater, and everybody decides that I want to watch a cricket match. What will happen? Will that theater be full? It will not be full. Okay. Only when there is a demand, that theater will be full. Only when the theater will be full, it will generate profit. And once it generates profit, it will come into the EPS and the fundamentals. Okay. So buyer demand comes only most of the times in the places where there is something happening in the positive side, whether you accept it or not. And it is a probabilistic thing. It will not 100% happen. Market will say that this is more likely to happen if there is CG Power news, which I was talking about. Now, they might not get approval, but market thinks that if they get approval and if they get, say, 10% of the semiconductor business, this is the kind of opportunity size, this is the kind of earnings it can do. Reasonably 20% probability is there. So this is the impact in terms of share price today itself it will do. And as the probability, as the possibility increases, the re-rating will keep happening, the earnings will come, then more and more confidence will build up and the share price will follow up. That is where you don't see everything priced in on one day. So here there was a news actually. So in the month of May, over here there was a news that they got a 10-year contract, but the price started moving almost a month before. And then there was a catch-up rally that, okay, if this is the news, this is the kind of earnings it can impact. Are you clear with me? And many times if there is a disappointment later on, it can even keep falling down. And that is the reason you need even exit strategy. You should be exiting somewhere here if your thesis doesn't materialize. As an investor, you should be very flexible, particularly with the satellite stocks, because there it is a possibility and it is a lower probability because it doesn't have a history. It is just trying to change. It's not a Titan or a Polycap. And not everybody needs to do satellite. You need to have a robust system around it. And that is where, even like the systems I use, it starts becoming red and it triggers exit. Same way, entire cycle which happened in graphite, right, in 2017-18, you will see the same pattern playing again and again. This is one of my favorite examples. So you will see that some of the markers are also there. But you can see here, the stock was not doing anything for years together. Like if you see 2-3 years, there was no demand at all. See, the volume is dry. That means there is no demand. But here there is buyer demand that has come in. Why? Because suddenly the prices of graphite shooted up because one of the major graphite electrode producers shut their shop. And in the expectation of the earnings, the stock price already started moving. And you can see the price volume action started generating here. And then there was a follow-up move. Again, once the growth goes away, you will see in these kind of cyclical stocks, it can go back to the same levels also. That is where you need, again, extremely important exit strategy. Again, see this. This is where the exit has already got triggered and then you are out for the entire period. Okay. Now, the beauty which I want to share with all of you is that most of the times the fundamentals will be lagging. Okay. So like if you if you see that my exit is triggered, say here your exit is triggered, or here your exit is triggered, or some fall has happened, and then you try to go back and see the fundamentals, a lot of time it can deceive you. Let me show you the same example itself. Let me see if I can bring this from Tijori, because they have quarterly earnings for longer period of time. Let me see if we can pull this up. So let's say HEG. Let's see its financials, and let's see the so if you see the quarterly result, I'll open up profit after tax or even net profit, both are same. So if we do the 5-year profitability, or rather 10 years, so that this gets included. Now see this. There's a very interesting data point. Like the fall started in October 2018. Okay. Now, October 2018, which result would have come in? September result would have come in, right? So till almost January 2019, you would have only the September result. All of you with me, right? Because September result will come in October or mid-November, and then the December result will come only in say Jan or mid of February, right? Now the fall started happening already. Even in Jan it was falling. December already it was 40% down. Now you go back to the result, you analyze the September 2018 result, and you say, boss, this is our best ever profit in the history of the company. Fundamentals are intact. This company is as solid as it can be. I am a long-term investor. This is doing good. Let me ride it. But the market is giving you a different signal, right? It's telling you that the party is over. But then if you check the fundamentals, it will not tell you so. Now, next quarter, December, the results might come into January or mid of February. From highest ever 888 crore, it is just 866 crore. So you can say all is well, all is well. ये तो 5-10% इधर उधर चलता रहता है यार. It is minor blip, temporary. ये सब तो फालतू है, लोग ऐसे ही बेच रहे हैं. देखो अभी ये वापस जाएगा ऊपर. By the time the March results comes, okay, by the time the March result come, say in April end तक आ गया है, you are 70% down. You are 70% down, by the way. And that is where the 50% drop happens, almost 30 to 40%. And that is not it. The price is actually even is a leading indicator of all the future 2-3 quarters fundamental changes that are going to happen. Same way, if you see the bottom which it happened, right? In March 2020, it was like minus 366 crore of profit. So March result would have come in April, right? So if you see here, April, the result would have come in. Say April, May, the result would have come in. But the price started shooting up right from here. And you will feel like, oh, boss, now it is just rising without any reason. It is just double without any reason. But it's actually preempting that the bottom is formed. The earnings are almost at a rock bottom. It is going to come at a rock bottom. And then the earnings are increasing actually. So are you getting it? And you can take n number of examples. 90% of the times you will see that even in the best of the best companies, let me go take you through Eicher Motors in 2018 pain period, right? So this was Eicher Motors. And if you go through the 2017-18, same thing. If you see, it was making a new all-time high, 3,200. Again, it's an adjusted price. And then it started falling suddenly. Okay, so from 11th September 2017 to August 2019, it was continuously falling. Now let's take the same example for Eicher Motor and let's see how does it look like. Okay, so let's go to Eicher Motors. Let's go to financials. Let's go to quarterly results. And let's look at the profit growth. Now see this. September 2019 was actually one of the best quarter. But what market was factoring was the subsequent quarters and the slowness of the growth over here. Are you getting it? So this entire period where it was not growing, that was already factored in by the market, where it was peak of the earnings. Here it was peak of the earnings. When you look back, you will feel like fantastic company. September 2017, best ever quarterly profits. Yes or no? But the growth was faltering. And for next 2 years, the growth did not come. It was almost the same. Even in 2021, it was almost the same. That growth, that same number of profit only came after 3.5 years. This was already factored in by the market over here. Can you see this? It did not go anywhere for next 2-3 years until the growth started coming back. And you can take so many such companies, and that is where, the kind of blend that helps you even in signaling, like even if you are fully focusing on fundamentals, technicals can help you give a lot of signals that, okay, look at your thesis again, try to relook and see if you are not wrong. That is how you combine both the things. Yeah, so enough talking. I think we'll open it up for question answers, but hope you liked the thought process and how we do what we do. And best of the companies also same thing will happen. Like recently we played BSE for almost 1 year. It did not do anything. It was like 50% down, and then 4 months it did everything. So sometimes the company's result might also not come in that duration, but it can get significantly re-rated. Yeah.
Yeah. So thank you so much, Vivek bhai. If anyone has any question, you can either type in on the chat box or you can either raise your hand. I'll unmute you and you can ask your question directly. Okay. So Jitendra ji, I have unmuted you. You can go ahead. Yes, Jitendra ji.
Sir, very nice program. Thank you, Ankit bhai. Thank you, Vivek bhai.
Thank you. Thank you.
How
Thank
are you,
you.
sir? Acha,
Well,
that suppose we are buying Safari. Example, we are buying Safari at 1,000 rupees. Fundamentally, Safari is good and we bought Safari. And suddenly after 1 month or 2 months, Safari become 750 to 800. So it fundamental driven stocks, whether we should keep stop loss technically. We bought Safari for 3-4 years, or assume we bought Safari for 5 years.
Correct. So see, this is what I follow. Okay. And it need not be like 100% true for you. It depends upon your psychology and your way of doing things also. But my way slightly is typical and different. So this is what I do if I am having Safari. Okay. So coming to your point, let me make this auto. Perfect. So this is like a recently listed company. So you will see like a smaller time frame. So say, for example, I think we should open the BSC one, then it will be much better. Yeah. So this is what I do, what Jitendra bhai, right? So basically my thought process is that whenever I'm entering any company, whether it is a core or satellite, first and foremost thing I do is I don't enter full position in one go. Never. I always buy in tranches. Okay. So whenever I want to buy anything, I'll buy a tracking position. Say at 280 rupees, I was interested about Safari. I'll buy first tranche over here. Then this is a monthly chart. Okay. So once in a month only I need to look, because I want to invest for long term. I don't want to look at prices every day in a good company, solid fundamentals company. So whenever it will form a new high and with a solid candle, that is what I follow technically, I'll add a second tranche. So maybe second tranche I would have added here. Then third tranche I'll add here. Say fourth tranche I'll add here. Say fifth tranche I'll add somewhere here. And I allocate generally 5 to 6% of my initial capital. Upar jitna ja raha hai, I'll ride it. But my capital more than 8%, I generally don't invest into one company. Okay. So this is where my full allocation will be complete. So this is called averaging up. As the price is moving up, I'm adding more and more of that. Now, this might sound very counterintuitive because हमें तो यही सिखाया जाता है ना कि सस्ता तभी होता है जब प्राइस नीचे गिरता है. बट सस्ता तब भी हो सकता है जब अर्निंग्स बहुत फास्ट आ रहा है एंड आपका प्राइस उतना फास्ट नहीं जा रहा है. राइट. सो योर अर्निंग्स आर मूविंग मच फास्टर and your price is just slightly lagging behind and the re-rating is slowly happening. So you are still actually buying cheaper. Now, to your question. So say for example, एकदम एक्सट्रीम सिनारियो लेते हैं. राइट. आपने यहां पे बाय किया, आप यहां पे इंटरेस्टेड हो गए, अब प्राइस गिरने लगा. So what should we do? So what I do is I simply follow my strategy. अगर यहां पे मैंने एंटर किया है, I'll exit here. I'll exit here based on my exit indicator, which is there on a monthly chart. I'll not enter and buy anywhere over here. Even if it is 300 rupees, thrower prices, 50 रुपए में मिल रहा है, I'll not buy it. There is a reason behind it. I'll tell you afterwards. Now, again, my company has started giving entry signals. So I'll buy again first tranche here, second tranche here, third tranche here, fourth tranche here, fifth tranche here, and then I'll ride the entire up move. Okay. Now, even if I have started buying at 600 rupees and completed it, say 1200 rupees, my average price might be 700 rupees. Still, it will be 4-5 bagger if it really works for me. Okay. Now, why I'm doing what I'm doing is for a very simple reason, because only God can tell you that sasta kitna hoga from 740 ye kitna niche jayega, right? I don't have that capability. I don't know whether it will go till 600. I don't know whether it will go till 400 or 300 या 50 rupees. कहां तक जाएगा मुझे नहीं पता है. So I don't want to even get into it, which is not possible to predict. And I will not be able to even find a bottom कि हाँ exact bottom पे पकड़ लिया, and it doesn't matter also. क्योंकि if at a 700 rupees price, if I make a 5 bagger, I'm still happy. Then making from a 500 rupees to 4,500, it doesn't matter. As far as I can deploy more capital and I can ride peacefully, it is insignificant. So the point is, I want only one company which can become like this in a portfolio and can go 10x, 20x, 30x, and that one company can change my life. Yes or no? Out of 20 companies in my portfolio, even one company happens like this, what will happen? Automatically, my allocation keeps increasing into that company. And that company, as it keeps going higher and higher, it will naturally make a new high and high. A company which is 100 bagger will make all-time high hundreds of times in its life. Yes or no? So I just want to align myself with such kind of possibility. Second, like there is a Safari industry, there could be some Yes Bank also, which was next HDFC, and it can come down also, right? So what happens if you do that, right? So if, say for example, I have bought a 1% like in Safari over here, immediately say my exit got triggered, but मुझे लगा कि यार ये तो HDFC बैंक बनने वाला है तो मैं यहाँ भी ले लेता हूँ. फिर किसी ने बोला कि हाँ यार ये तो बहुत और सस्ता हो गया तो मैं यहाँ भी ले लेता हूँ, यहाँ भी ले लेता हूँ, यहाँ भी ले लेता हूँ, यहाँ भी ले लेता हूँ. One company like this can be sufficient enough to erode my 60-70% of capital. Yes or no? I don't want to have this situation occur in my portfolio any point of time. And the only way I can do it is not buying cheaper in terms of price. I might still be buying cheaper based on the valuation. But just because of the price movement, if just because it is going down, if I keep accumulating it, I'll not align with that possibility that one winner can change my life. Okay. So that is how I think. And that is what is the thought process. That is how I go about it. Hope that makes sense. And this is a very counterintuitive way. Not everybody does it. And it's a very psychologically difficult thing to buy at a higher price. But I am habituated to it. And another thing which is very important is you need to have exit strategy if you do averaging up. अगर averaging up कर रहे हो, फिर yes bank बन जा रहा है, and if you don't sell it, then you are doomed. So both the things in combination are required if you do averaging up. Otherwise, it will not work.
Thank you so much, Vivek bhai, for the detailed answer to this. And I'm sure all the audience would have learned a great deal from this style. And I have no shame in admitting that I feel it. I fell for this trap so many times because I don't follow
अरे हम
chart.
लोग स्टार्ट तो ऐसे ही सब लोग करते हैं, मैंने भी काफी कंपनीज में किया है.
Right, right. So I'll take up a few questions from the chat box. Somebody is asking, how do you differentiate allocation based on core portfolio and a trading bet in terms of portfolio percentage?
Yeah, so percentage overall at a portfolio level, core is 70%, satellite is 30%. And satellite में the position size initially might be small. So instead of say 1% tranche, it could be a 0.5% tranche. And there I also see overall market condition also, how does it look like. But the major difference in terms of allocation will be like here you add monthly. Like say for example, if you go about say Titan itself, right? So if you are having Titan, every month you are adding and you are not in no hurry, right? So you keep adding every single month and it is slowly compounding. You have a long time horizon. But for a satellite company, say for example, if I talk about recent example like Premier Explosive, which I had, okay. So Premier Explosives, monthly would be too difficult time period to write because it's a cyclical company, right? So there you can even do a daily time frame. So this is how this came in our radar. So in terms of satellite, we basically follow a lot of these cup and handles and a lot of these patterns also. So this was actually a very classic kind of cup, kind of all saucer kind of pattern. And then here there was a price volume action that started. And this is where it gave a classic breakout. And this is where we entered. Okay. And based on the daily indicator, it only gave us exit around here, right? So from almost 500 rupees to almost 1100 rupees, we were able to write just simply by following. And then we got out of it. So this is how it works. And then if you want to re-enter, we again look for such kind of price volume action and pattern around it. Similarly, BSE is a in between. It is slightly cyclical because equity markets are still cyclical, and it is not satellite also. So it is somewhere between core and satellite. So this is where we ride this on a weekly basis. So this is how the BSE position we are riding. This is still in my portfolio as a disclaimer, and we are still open in open position. But this is how this BSE worked out. Another thing technicals can help you is to play turnaround sector. So we played pharma and tech sector just using a simple technical pattern called a cup pattern. Okay, so cup looks like this. Any turnaround sector has to form like this, most likely if it is a sharp turnaround, and you go through multiple stocks, good quality stocks in pharma and technology. I'm just giving you some examples. It is not a recommendation not to buy right now, but you take some of these best of the good stocks. It like a charm gave you opportunity to play this pattern. Can you see this? From 458 to almost 770. Current example right now, which again I'm holding as a disclaimer, is Aurobindo Pharma. Just see how exactly same way it is played out. Just the simple cup pattern. You go through a lot of these IT companies, right? Mid-cap IT companies. You will see the same pattern, which is formed. Okay, so you can see emphasis. It is forming the same pattern. Can you see this? It is forming a cup pattern. Any other tech companies you can think of? Mid-cap tech companies, type in the comment box. You can go through some of these. Yeah. So mid-cap, good quality tech companies. Same way, in pharma, you have a lot of other names also, like Sequent is just going through that phase right now, like it is in the bottom of that curve. Can you see this? Like it is just getting started and trying to form this cup. And the good part is once the sector turn around, the stronger ones will form the cup first, the medium one will form in the middle, and the last one will form in the end. So you can get opportunity even after seeing a couple of companies like that. Okay. Yeah, so which one? Any tech companies you guys want to see? You can take a couple of examples. Let me see if I have examples here. Yeah, Persistent, I think, followed the same pattern. And see, you have a fundamental comfort that, it's all doomsday is out, all the valuations getting cooled down, all the froth getting out. So that way it is kind of value investing because you are getting it cheaper. The sector is turning around. See this formed a small cup here and then ultimately going down. A lot of these companies like Birlasoft, you will see the exact same pattern. This is like perfect picture, perfect pattern. This I'm currently holding again as a disclaimer. Yes, can you see this? Simple, nothing too complicated. Okay. So same way, if you see some of these other players like Newgen, and at the same time, mostly it will start when the entire sector is turning around. See this? A lot of these tech companies, right, all which got listed at a very high valuation. Zomato, same pattern. Yeah, can you see this here? Started turning green and it is already in progression to forming it. So this is how, some of these simple patterns can also help you make a lot of money and also play turnaround stories at a cheaper valuation and helps you do a lot of value buying also.
Thank you, Vivek bhai. The next question, I'll move on to the next question. I don't see any hands being raised. So I'll move on to the next question on the chat box. Sir, is this Shaktiman indicator a public indicator or is it a proprietary indicator which you have?
This is a proprietary, but you can use simple indicators. I'll tell you which all indicators you can use for freely. So you can use something called as EMA, exponential moving average. That works almost in a similar way. You can use something like parabolic SAR, right? That works on a similar way. You can use something like a V-stop, right? Which is a volatility stop. Pretty much there are, see, indicators, you get it everywhere, right? It's like what problem you want to solve. My simple thought process is that I want to avoid big consolidation and I don't want to prematurely exit a ongoing trend. Even in between, there could be overvaluation that can happen. You can even tighten your indicators. So what I would suggest all of you is to first understand what is the purpose you want to solve from your fundamental side of things. That, okay, this is my problem which I'm not able to solve through fundamentals. Then you look for the indicator. That is how the thought process should be. It's like, आपका क्या खराब हुआ है घर में, and then you find a tool around it to repair it. That is how you should think about it.
Sure. The next question is from Ashish. Based on your Technofunda rules, do you like buying the pessimism in good quality companies which were down due to sector headwind? Example, chemical sector right now.
Yeah, so I would only like to buy when the headwinds are about to complete and the tailwinds are about to start. That is what. So I'll not buy here. I'll buy at the same price probably at here. Okay, so not at a, because I don't know how much that pessimism will continue. So I'll let it form the bottom, let it form the base. Once the 60% kind of cup is built, then I'll enter. And then still it can happen that it can again start falling down, right? It is not like 100% it will happen. So that is where your tranching will happen. So you have taken a first tranche here, say second tranche here, and then here your exit trigger. So if you are wrong, you can also get out because we don't know how much that pessimism will continue. See the real estate sector, how many years that pessimism continued. Now, if you would have entered in 2013 thinking that, it's pessimism, let's enter, you lost 5-7 years of compounding. So I don't like to play extreme pessimism. I like market to prove that pessimism is now over and it is turning towards optimism. That is how I like to think about it.
Sure.
And there is nothing wrong, by the way, to play pessimism. So there are people who have made a lot of money through pessimism, just through special situation, just through, buying in a consolidation base. So there are thousands of ways of making money. You should see where you resonate with. If you are able to pick up a cycle, you can pick up a bottom, you can understand at a ground level if it is like really a good time to buy, definitely you should do it. It's not like you should not do it. It's just that I don't do it. That's it.
Amar is asking, real estate now is getting tailwinds, right?
Yeah.
According to
Now a
your-
lot of companies are making new highs also, new all-time highs.
Okay. Any other sector you would like to talk about right now? Which are
Right now, turning around sector, I think IT pharma is like definitely going on. All these platform businesses which were listed at very high valuation, it's already ongoing. It's like in front of us. Auto ancillary, it has been happening since some time. So auto ancillary, I feel a lot of things have been priced in. Power sector, almost like a year, it has already been priced in. So it's already gone.
any sector to avoid according to you right now?
Right now, I think anything which has big headwinds, like right now, I'm not very keen on chemicals as yet. So you can avoid that.
Right. So I think we have covered all the question. Let me just check once again. If anyone has any question, you can either raise your hand or you can type in on the chat box. We still have time. Yeah, so somebody is asking about cables and wires.
So cables and wires, see, good quality companies can do well. Personally, I am holding KEI and Polycab since quite a long period of time, and I'm still bullish about it. So far, I am not seeing any bad signs over there. Again, not a recommendation to buy right now, but yes, still looks like it is going fine, the overall sector as such.
So Jatin is asking, can you please describe your screening process for satellite stocks?
So it's a slightly longer story, but I'll just give you the glimpse of it. So basically, to screen the price action, I have my proprietary tool called Ride Winners. I deliberately did not show it because, sometimes I don't prefer showing paid tools on a free session. So basically, what I do is I see the price volume action in the sectors first. That okay, which sector there is some kind of move that is happening. So these are all percentage of companies showing price volume action in a particular subsector. So I look more from the subsector perspective than the sector perspective. So say, for example, there is suddenly something starts becoming green, right? So it becomes dark green and it is increasing trend. So let me see if I can pick up one or two such examples, live examples right now. So say, for example, railways, all of you might be tracking any which ways, right? So it is suddenly becoming green, right? So it was almost 0, 33, and then it is again picking up 58 and 50. So a lot of companies in the railway sector is coming. So I'll probably mark that as favorite. Then I'll go and check other sectors. So say transport and shipping, there is some kind of move that is happening. So it was almost 0 and some traction was there. And now 2-3 companies are coming in the picture. So I'll shortlist 2 to 3 such sectors where there are some tailwinds. And then you go to the individual companies that, okay, which companies are making that kind of price volume action. And then further, I check the charts of that company that, what kind of price volume action is happening, whether there is any kind of patterns that is happening, whether there is any breakout that is happening. And then I take a call whether to get into it or not. Like this is my last week's watch list. So this is how I shortlist like number of companies. And every week within those list of 70, 80 companies, I shortlist fewer list of companies. And then from that fewer list of companies, I again shortlist even smaller, fewer list of companies, and then decide to enter or exit. That is how it goes about in satellite portfolio side of it. But the starting point is sector, then the company, then the pattern and chart, and then I check the risk reward and then the tranching. That is how it goes about in the satellite stocks.
Thank you, Vivek bhai.
And by the way, yeah, once I get the sector triggers, I also check the fundamental triggers of that sector. So what is happening in railways, what is happening in defense. So some of the examples I've already shared in my YouTube also, so you can check, like there are, last year I did a detailed video on railway sector. I did a detailed video on defense sector. So the kind of research that goes after that, you can check that. It's like an entire 1 hour video. So you'll get an idea of how much depth we need to go after even spotting the sectors. Because getting that conviction is where fundamental is very, very important. Because if you don't get a conviction, or even if you just ride through a price volume action, but there is no earnings trigger there, or the earnings trigger is very temporary, or it is news based, then those breakouts and all those things will fail. So that is where it becomes very different from people who just look at price and screen and just jump in.
Right. So I think Bharat is asking, do you track all market cap companies like micro and
All
small?
market cap, all market cap, yes.
But I think you don't trade in any F&O. It is all
F&O I don't do. No F&O, no intraday. F&O active भी नहीं है account में. करना भी है तो नहीं कर सकते.
Great, great. I knew that. I just wanted everybody else to know about it.
See, you saw these kind of charts, right? So the point is very simple, guys. If you see Zomato, it has become like 2x in 4 months. If you see BSE, it has become 4x in 4 months, right? Then why you need to run for 1% return every day if you can do such kind of compounding, and even core compounding like Polycab, you can do like 4x in 4 years, right? So why to run behind 1% every day and then spend your time, energy, and every new day find new opportunities? That is what is the problem.
Right. So thank you so much, Vivek bhai. It was great learning from you.
Thank you so much.
Hope to have you soon again with a new presentation so that we can learn more.
Thank you so much.
Thank you everyone for joining in and asking some really good questions. Thank you everyone.
Yeah, thank you everyone for your time, and hope it was value add for all of you.
Yeah, thank you.
If you enjoyed watching this session, then please do like and share this video and subscribe to our YouTube channel. Also, अगर आप लोगों को ऐसा पर्टिकुलर इन्वेस्टर है जिनका एक पर्टिकुलर सेशन देखना चाहते हैं, then you can also write his name in the comment section below and we will ensure कि वो हमारे प्लेटफॉर्म पे आए ताकि हम ऐसे और enriching videos हमारी ऑडियंस के लिए ला पाए. Thank you.